For a long time, the ultimate financial milestone for a young adult was buying a house. But today, for millions of millennials, the new milestone of financial stability is simply building a fully funded 6-month emergency fund. When you finally scrape together $20,000, you want to protect it. You want it safe from the volatility of the stock market, safe from inflation, and safe from economic crashes. If you are like most financially aware millennials, you didn't leave that money in a traditional checking account. You did your research. You moved it into a high-yield savings account paying around 4.5%. You check the app on your phone, you see the monthly interest deposit, and you feel like you have successfully outsmarted the system. But you didn't. The math isn't mathing. Your bank is still making exponentially more off your deposit than you are, and the exact thing your high-yield account is doing with your money to generate that interest, you could have done it yourself and kept the full yield. Today, we are going to look at the psychology of financial safety. We will expose the real math behind the banking industry's net interest margin, uncover the hidden tax traps in your savings, and explain why your desperate need for safety is structurally designed to keep you poorer. Let's introduce two people, Maya and Jordan. They are both millennials, both make a decent salary, and they both successfully saved $20,000. Maya represents the average American saver. She did exactly what society told her to do. She kept her $20,000 in a savings account at a massive traditional national bank. She checks her balance every month, sees a tiny interest deposit, and feels responsible. Right now, the national average for a traditional savings account is roughly 0.38% APY. On $20,000, Maya's bank pays her exactly $76 a year. That is about $6 a month. Not even enough to buy a sandwich. Maya probably assumes her money is just sitting in a digital vault, waiting for her in case of an emergency. It isn't. The moment Maya deposited that money, the bank put it to work. Not for her, for them. The core business model of every bank in America relies on a concept called the net interest margin. They take your deposit, pay you a fraction of a percent, and immediately lend that exact same money to someone else at a drastically higher rate. Let's look at the real math. Maya's bank takes her $20,000 and lends a portion of it to credit card holders. In 2026, the average credit card APR is hovering around 21%. The bank pays Maya 0.38% and charges someone else 21% for using Maya's money. That is a spread of over 20 percentage points. The bank didn't hold Maya's money. They rented it. They paid her $76 a year for the right to use her $20,000 to generate thousands of dollars in profit for their shareholders. And Maya thanked them for the $76 because it felt safe. Now, let's look at Jordan. Jordan is the person watching this video right now, thinking, I already knew that. That is exactly why I moved my money out of a traditional bank and into an online high-yield savings account. Jordan is not wrong. He is way ahead of Maya. His high-yield account advertises a 4.5% return. On $20,000, Jordan is earning about $900 a year compared to Maya's $76. He thinks he cracked the code, but Jordan is still falling into a sophisticated psychological trap. The first problem is something hidden at the tax trap. The interest you earn in a savings account is taxed as ordinary income. You have to pay both federal taxes and state and local income taxes on every single dollar. If Jordan is in a 22% federal tax bracket and lives in a state with a 5% income tax, he is losing over a quarter of his interest to the government. His $900 victory shrinks to roughly $657 after taxes. But the second problem is even bigger, and it is the question Jordan never asked. Where exactly does my high-yield bank get the money to pay me 4.5%? They are running the exact same machine as Maya's bank, but there is one specific trade they do that should make you furious. Jordan's bank takes a massive portion of his deposit and buys short-term U.S. Treasury bills. Right now, short-term T-bills are yielding around 3.6 to 4%. The bank buys those treasuries with Jordan's money, collects the yield, and passes a cut down to Jordan. The bank is acting as a literal middleman between Jordan and the United States government. So why doesn't Jordan just buy the treasury bills himself? Because of behavioral economics, millennials grew up watching the 2008 banking collapse. Our nervous systems are terrified of financial risk. The banks know this. They know you will gladly pay a massive invisible premium just to see the FDIC insurance logo on a sleek mobile app. But here is the ultimate irony. Treasury bills are debt issued by the exact same U.S. federal government that backs the FDIC. When you buy a T-bill, the risk of default is essentially zero. Because the government has the ability to print money to pay its debts, you are not giving up safety. You are just cutting out the middleman who is skimming your profits. So, how do you fix this? It requires a concept I call status suicide, bypassing the bank entirely. Imagine you take that same $20,000 and put it into a short-term Treasury bill ETF, like SGOV. You buy it through any standard brokerage account. The ETF takes your money and invests it directly into U.S. Treasury bills that mature in 3 months or less. SGOV's yield tracks actual Treasury rates, meaning there is no bait and switch where a bank quietly lowers your rate after a 90-day promotional period. But here is the absolute game changer. By federal law, interest earned from U.S. Treasury securities is completely exempt from state and local income taxes. Jordan pays federal and state taxes on his high-yield savings account. The SGOV investor only pays federal tax. If you live in a high-tax state like California or New York, that tax exemption alone can mathematically beat the highly advertised return of a high-yield savings account. And the fee to run this ETF, it is 0.09% a year on $20,000. That is $18. You don't need to close your checking account. You still need it to pay your rent and buy groceries. But your idle cash, the money you are hoarding because you are terrified of an emergency, does not belong in a savings account. You can use a Treasury ETF like SGOV. You can buy treasuries directly from the government, or you can use a Treasury-only money market fund. Maya did everything right by the rules she was taught. Jordan did his homework and found a better rate, but neither of them realized they were just renting their capital to an institution that was making 10 times more off their anxiety. The smartest financial move you can make today isn't finding a bank with a slightly better savings rate. It is asking why you need to use a bank to hold your savings at all. Are you still keeping your emergency fund in a standard savings account, or have you made the switch to treasuries? Let me know in the comments below. And if this video helped you see the real math behind the banking system, hit that like button and subscribe.